today, our agenda today is to discuss what makes us unique here at A&I Financial Services. We're going to describe to you our investment philosophy, including our unique patented investment process. And then if there's time, we're going to encourage you to send us an email or contact us for further questions. Well, we've got a fantastic team here at A&I Financial Services. I'm so lucky to be surrounded by some of the best people I've ever met. As some of you know, I've got a number of master's degrees. I was the president of the Financial Planning Association of Colorado. I work with the CFP board. I've done a lot myself, but this group of people puts me to shame. They're so wonderful. My wife is a second-generation business owner. She specializes in working with women. Bret and Chad have life insurance and annuity expertise, second to nobody, and they are a resource we all lean on. Also included in the team, just to name a few, Francois Giguère was the general manager of 2 hockey teams, and with the Colorado Avalanche, he won the World Championship twice. Standing beside Francois on the picture is Dave Stevens, who started in the industry about the same time this firm started in the 1980s, and is a fantastic resource for us. He's also a CPA. Not far from Dave in the photo are Peter Langfeld and Marla Mason, and they are professors of certified financial planning. So not only are they CFPs, they teach other people who want to become CFPs how to do that. Last but not least are Cameron Morgan and Judson Cass. They bring a huge amount of experience. Cameron all over the world, and Judson on the Chicago Board of Exchange trading floor before he became a financial planner decades ago. This is just a fantastic team. So experience is a big part of what we bring here at A&I Financial, but it's not the only one. In fact, what I would say are our top 5 differentiators. The top of that list is that we care. And the client care team, who I didn't mention by name on the previous slide, are fantastic people. They will answer the phone when you call. We know who our clients are, and we really become friends. You're like our extended family. So we live that. We care. Not just that we say that. I hope you feel that here at our firm. And we have an unbiased expert team. That's a huge differentiator between us and our competition, that we provide for the same fee that everybody does, just an industry standard investment advisory fee. We provide you access to a CPA, to an estate attorney, to insurance experts, life insurance, home and auto, lenders, and business valuation experts, a huge array of experts. And we've got a process. If you have a group of people who you love working with, we'll integrate them into our process and make it more easy for them to communicate and share with you, as well as for you to make a decision. So the unbiased expert team is one of the big differentiators here at A&I Financial Services. The third thing on the list is today's topic. That's our patented investment process. More on that in a minute. And, we only work with a small number of successful families. So if you're already a client, thank you. And if you're thinking about becoming a client, know that it's a two-way fit. And we just really only want to work with people for whom we can make a significant impact. So thank you for considering us, and we look forward to talking with you. Finally, and I hope you gather this, that our firm is a firm one with gratitude and humility. There's only so many things we know, and we know that there are a lot of things we don't know, and we look for that, and we find experts to surround ourselves with to bring you the absolute best financial planning and financial experience that we can. So that's a little bit about what makes us unique. Without further ado, let me introduce my partner and wife, Stacey Frey.
Thank you, Karl. I appreciate that introduction. And I'd love to share with you some of our thoughts about how we understand that you may experience investments sometimes. We want you to know that we hear you and we listen to you. We understand that all things given, all things being equal, you would love to have a 10% stair-step experience in your investments as your investments grow over time, that you would love a steady, predictable return. And though we would love to give that to you, we recognize, and you recognize, that isn't possible. Instead of getting a stair-step type return pattern, what instead you might get is a roller coaster. A perfect example is 2020, when investors entered the year full of confidence, and instead the world caught coronavirus. And we understand that it is difficult to be invested in equity markets because of that roller coaster ride. And even though the stair steps and the roller coaster might end at the same place, the experience getting there is very different. And frankly, some investors really can't stomach it. So what do some investment managers do? Unfortunately, what some other investment managers do is over-diversify their client's portfolio in order to smooth the ride. What happens when that's done, however, is that you lose some of the potential return of your portfolio, and we want to offer something very different to you. We will give you the resources you need to stay in your seat while keeping the wealth. We do not want you to forego wealth just so that you can have a more comfortable experience getting there. We believe that the right way to invest is by strategy, and we diversify by strategy in order for you to get the equity returns that are possible in the market without having to second guess all the emotions that you have along the way. We really want to give you the tools you need to stay in your seat so that you can be as wealthy as possible. We really want to help you get there. So Karl spoke just a little bit about what we believe as a company and the core principles that Karl and I really spent time with as we began leading this company many years ago. And our investment committee has a similar set of core beliefs. When we look at our investments, we first of all believe in doing our homework. We believe that quality inputs generate quality results over time. We do not skimp there. Secondly, we believe, and this is one of the most important things, we believe that investor behavior is the single greatest determinant of your financial success. Let me just say it one more time. We believe that your behavior, your ability to participate in the market is the biggest determiner for your eventual financial success. Next, we believe that asset allocation, particularly your exposure to equities or stocks, is more important than the timing and selection of particular investments. Next, we believe, with history as our guide, that stocks will continue to yield better returns over time than other asset classes. We also believe that combining time-tested strategies with high conviction consistency, we can potentially generate superior investment returns over time. That's our commitment to you. And lastly, but not least, we believe in the ongoing and rigorous due diligence and testing of our beliefs. Now, the four folks that you see on this call, Karl, myself, Bret, and Chad, we're all partners. We all sit on the investment policy committee, and we all actively participate. Every advisor that Karl mentioned in the photo that he was referring to early actively participates and supports the purpose and work of this group. We meet every week, and we actively challenge all of our beliefs. We put a lot of homework and thought into choosing our investments. When you look at the folks around the table, there's over 100 years of investment experience. We want you to benefit from all of that hard work that we're doing on your behalf. Now, to complement the bench strength of our investment policy committee, we also use the support of two outside research partners, which Bret will discuss a little bit further in this presentation, and those partners are Athena Invest and Littman Gregory. Now, we talked a little bit about investments, and I'd like to take it just a little step further, and maybe we're looking at the tip of the iceberg with the investments, and really the bottom of that iceberg is the most important thing for us and for you, which is what are your goals and your values, and what are the relationships that are most important to you. We really value and spend a lot of time and energy on that discovery process because we really want to understand what your goals are and what type of financial plan we need to build in order for you to meet your goal. We recognize that if you have a financial plan that's built for your goal and we hire then investments to be in service of your plan, that you'll be able to participate in the market to the extent that you need to in order to meet those goals. We believe in real life long-term financial planning. That helps you avoid those day-to-day fluctuations and emotions associated with the market. And next, because we do create a customized plan for you based on your goals and your relationships and your needs, we also customize then at the end the selection. we make sure that when we look at our model portfolios that we've customized them for you. For example, if you have, for example, a large concentrated position, we work with you to make sure that your overall portfolio reflects the risk tolerance and the exposure that you need to the equity markets. We also understand that now is a really divided time in our country, and we want you to have the opportunity and the flexibility to put your investments behind your belief system. For example, we have portfolios that focus on environmental, social, and governance concerns, and we want to make sure that you can invest in the ideas and values that you're most passionate about. And last of all, as many of you know, if you've been longtime clients of ours, is that we do actively do tax harvesting every year. And this means that we actively go in to your account and we selectively sell investments in order to mitigate your tax bill at the end of the year. And we found that that creates a really nice savings for a lot of our clients each year on those taxable accounts. Now, next I will hand it off to Bret, who's going to talk a little bit more about how our partners support our investment decisions.
All right. Well, thank you very much, Stacey. I appreciate that intro. As we start looking at how we manage money, one of the important things that we've done is we've decided to partner with some very, very, very strong investment managers out there. The first of which we use is Littman Gregory. Littman Gregory is a very, very large asset manager. They have several $1 billion of assets under management. What that's allowed them to do is become very large and have a lot of resources to bear, and that's where we partner with them. We take advantage of those resources. If you think of the investment world or the mutual fund world, there are about 20,000 different mutual funds out there. What Littman Gregory, because of the resources that they have, they are able to go out, research all of these investment managers, and basically bring that down. So if you think of the 20,000 as the universe, think of Littman Gregory whittling that down to about 200 to bring it into the solar system. Those 200 mutual funds you can guarantee are some of the best that are out there because of the research that they have done. Now, when we look at Athena, Athena helps us take it from the solar system down to the planet, down to your portfolios. What Athena does is that they have the ability to look at these 200 recommended funds and put them through their own filter so that by the time we've gone through both filters, we come out with the funds that we end up with in your portfolio. So let's talk a little bit about Littman Gregory. As you can see in that second row of investment experience, these are some of the managers at Littman Gregory. They have a lot of different people that are underneath them, but these are the main ones that help drive some of the research that is going on that we take full advantage of. As you'll see as we go through this, one of the things that we really enjoy is the fact that because of Littman's, the partnership with Littman, we have access to these actual investment managers as well. A lot of other firms, they'll be talking to the marketing and the salespeople. We'll get right in there with those investment managers who are doing the investments. One of the important things about these guys is when we're talking to these investment managers is, are they convicted enough to put their own money in that fund? That's important. Another thing that happens when we're talking to these managers is we say, congratulations, you're now on Littman Gregory's platform. You can kind of hear them take a sigh when we say that, and the reason for that is they tell us that the interview process that Littman puts them through is one of the most grueling that they ever had with any other portfolio manager. As you can see here, it's a several-step process that these managers go through. The first part of it is done internal at Littman Gregory. They're going through and doing all of this due diligence on not just the performance and the expenses on the quantitative side, but you'll see on the qualitative side, there's a lot of the management style and how are these guys going out and determining what type of funds that they are buying? Are they consistently having the same message? Because what you don't want is something where the manager's saying he's doing this, but instead is going over here chasing some other type of return. Well, that doesn't do us any good because we might already have somebody in that spot. So the combination of all of these steps, etc., this is what really allows them to bring, like I said, that universe down to the solar system. So let's talk about the ones that bring us down to the planet. That's Athena Investments. Athena Invest was started by Dr. Tom Howard. He started this years and years ago, and prior to that, he was a professor at DU. In fact, Karl didn't brag about it too much, but he's got several degrees from DU, and Dr. Howard was his professor for several of those. But when he left DU, he came up with a research, he and his team started doing years of research and ended up with a process that they recognized, how do these investment managers manage their money? What is their strategy? You'll see that as one of the three tenets here as we're talking about Athena Invest. Well, that process that they've discovered and these different strategies became a patented process. This process of selecting managers based on strategy is patented. You can actually see the different patents that they have. That means that you get to take advantage of a patented investment philosophy. Strategy, the conviction of the manager, and the consistency by which they invest is extremely, extremely important in how we choose your investments for your portfolio. So what I'm going to do now is I'm going to turn it over to Chad. Chad is going to be talking about a little bit about how traditional investments have taken place and talk about some of the other things that have led us to where we are.
Thank you, Bret. I appreciate that. What we see on our screen here are three examples of portfolios that we come across as financial advisors on a regular basis. The first of which is something we were all born and raised on, which is the blended approach, a 60-40 portfolio. Here we have different pieces of the pie representing different objectives. We've got a bit of the money in the stock market that's focused on growth. We also have a much more conservative piece that's going to have a bias towards things like fixed income investments or bonds. The reason this has stuck around forever is because for a long time it worked great. The problem is, in the world we live in today, many of these assets have become highly correlated, meaning that they move in the same direction at the same time, and that's what we want to avoid. We're also navigating an environment where the Federal Reserve has manipulated interest rates down to historic lows. So the bond portfolios may not be offering the income an investor needs to be able to achieve their retirement objective. So the investment community matured, if you will, and they started to incorporate things we refer to as the style boxes. Here inside a portfolio, we start to discriminate not just between stocks and bonds, but between the size of the company we're investing in. Is this a big blue chip mega cap company like Apple or IBM, or is this a small startup company poised for rapid growth? We also discriminate between whether they're taking more of a value biased, paying out a dividend to their investors, or they're taking their profits and reinvesting it into the company to support future growth. The result of that is what we see on the right. And that is an over-complex portfolio we refer to as global mush. Now, it's not that we don't believe in diversification, but if you take it too far, the result is giving up long-term performance, and that's what we want to avoid inside the investment accounts. So on the next slide, we're going to see an example of a portfolio that has picked one mutual fund in each one of those style boxes to invest in. And on the, for instance, in the U.S. large cap growth category, you'll see the average number of companies one of those mutual funds is exposed to inside the mutual fund. In this example, if you were to build a portfolio with just one investment in each one of those boxes, the result would be over 2,000 different companies getting a piece of the pie, literally and figuratively, inside your account. And the issue here is that Even if you had $1 million to invest inside your IRA, you would have less than $500 exposure to each one of those ideas. And the result is that we're not getting a meaningful enough piece of the best ideas that are out there, resulting in long-term underperformance inside the account. So when we build an allocation for our clients, we start with what we refer to as needs-based financial planning. Rather than starting at the top, which Stacey mentioned, do we invest in IBM, or do we invest in Microsoft? We want to start taking a look at the client's overall financial situation. And first and foremost, we protect against catastrophic loss. If we haven't taken a look at some of these knockout blows that can come in and really throw a wrench in your retirement plan that's unrecoverable, we haven't done our jobs. So we buy things like homeowners insurance to protect against our house burning to the ground, or an auto policy for our car. It may include life insurance policies to make sure that your family and your spouse are going to be protected if you were to pass away prematurely. Once we've taken care of some of those major risks, now we need to understand our clients' liquidity needs. Oftentimes, we have goals that need to be addressed far before retirement age. An example could be something like a home renovation or a major purchase like a vehicle. Maybe we're trying to put our children or our grandchildren through college or pay for a wedding. The money that's invested for these short-term liquidity needs to be addressed much differently than the assets that are going to be supporting your lifestyle 20 and 30 years from now. Principal protection is our goal. And once we've taken care of the liquidity needs, now we can get into building an income stream for our clients. Here, that income could be created from something like yield off a bond portfolio or dividends coming off of your stock portfolio. But the goal here is to support your lifestyle and make sure we have enough money coming in on a monthly basis to pay the bills. And then and only then, once we have addressed the catastrophic events, the short-term liquidity needs, and we've built an income stream that's going to support our lifestyle, now we can truly invest for long-term wealth accumulation. And here we're going to have a bias towards assets with the highest expected return over a full market cycle. I love this slide because it points out what sometimes is not so obvious, which is the primary risk of each one of these strategies. When we're talking about liquidity, okay, I mentioned that stability of principal is our goal here. The biggest risk is losing money. So if I have a goal to put my children through school and they're going to go to CU down the road up in Boulder, and tuition's $40,000, if I invest into a portfolio where that now becomes $30,000, guess what? I've just increased the price of tuition by 25%. We all know that school's expensive enough. We don't need to be doing them any favors. So we want to make sure we take care of what we got first and foremost. When it comes to addressing some of the income needs, the goal here is keeping up with that lifestyle that we've all become proud of and comfortable with. The last thing any of us want to do is go backwards. So taking a decrease in our monthly paycheck is what we want to avoid. And now, as we look at the equity component, really where we're investing for long-term wealth accumulation, you'll notice that the biggest risk is not volatility or the bounciness of that portfolio. The biggest risk is underperforming. Because we have prudently addressed all of these other aspects of our clients' financial plans, it allows us to have better investment behavior and stay invested in the market even when times are scary, because we know those dollars aren't going to have to be accessed to achieve our short-term goals. Several years ago, a study was done that we have found to be truly eye-opening when it comes to which investments have a better chance of setting us up for success moving forward. And when we talk about looking at past performance to make investment decisions, we call that performance chasing. It may seem like the obvious thing to do, find an investment with a solid track record. But look at the results of this study. What we saw is that over a 15-year period of time, what we would consider a full market cycle, the mutual funds that were able to outperform their benchmark over that period only achieved their goal 6 times out of 15 years. That means that as the investor, over half of the time you sit down and evaluate your plan, you're going to be underwhelmed and second guessing your decisions. Conversely, when we look at the investments that underperform their benchmark over that same 15-year period of time, believe it or not, they were able to beat that benchmark 11 out of 15 years. What this tells us is that taking a look at a period of time and strictly building a portfolio based off historical performance may not be in your best decision. If we choose those investments that have recently outperformed the market, the odds they continue on that trend are actually much lower than taking a look at investments that may have recently underperformed. Everything moves in cycles, and this performance chasing and dumping is something that we want to avoid. So I'm going to hand things over to Karl, and he's going to get into the nitty-gritty details of where we start when it comes to building portfolios for our clients.
Well, thank you, Chad. That was great. If we can't rely on past performance, then what can we rely on? The disclosure statement for almost every investment ever made says something along the line of past performance is not indicative of future performance. So what are we going to use? Well, the patented investment process that we use divides every strategy into 10 different buckets. There are 10 different ways that investment decisions are made. And let me use an example. So one of the most famous investors of all time is Warren Buffett. And Warren Buffett used to tell a story years and years ago. The type of company he likes to buy was like a cigar butt. It's the butt of the cigar. If somebody else has smoked the cigar and thrown it on the sidewalk, Warren picks it up and makes as much money off of that as he can. He smokes that cigar butt that's really gross and algae, but that's Warren Buffett's own words, and he would make a lot of money off of things that other people are throwing away. Now, completely different from that is what's called future growth. And future growth in the year 2020 is killing it. These are the technology companies that are making the news. In fact, they're getting so big, so fast. There's antitrust lawsuits going on from the U.S. government and other world governments against some of these companies. And so future growth is a completely different style of company than the cigar butt deep value style investment. And over time, different strategies yield different results. And that's what this slide is showing you here, that the best performers are the ones above the line. Over long periods of time, some strategies do better than others. The thing is, we just never know in advance which one's going to do better. So we want to have a little bit of money in some of the best performers. And over a long period of time, it looks like future growth has been the best performer. Certainly most recently in 2020, it has been. But valuation is one of those. So Warren Buffett, over long periods of time, again, he may be the world's best investor. His type of strategy has done really well too, and so have several others. And so behind the scenes, this is the way we're thinking. This is the patented investment process. This is how we're evaluating the options that, like Bret said, that Littman Greggy are giving us in our solar system to wind it down to the planet that we're going to invest on. So a typical equity portfolio, the way that we look at it, would look like this, and we'd have a little bit in different strategies. And we'll customize this, like Stacey said, for each individual client. And if you have a concentrated equity position, we're going to build around it to have companies in your portfolio that move differently than the stock that you've got a lot of money invested in. And if you like environmental and social and other concerns, we're going to build a portfolio around those as well. But behind the scenes, this is the way we think about it. We think about it by the way the decision is made. The right way to invest is to diversify by strategy. Now, what you see looks different. What you see might look something like this, where all the bluish slices of the pie are your equities, and the golden colored slices are the bonds in your portfolio or the fixed income portion of your portfolio. Behind the scenes, we're using strategy to make those decisions, and we want to diversify you in a way so that we give you the best chance of success in the future. And that's the patented investment process that we're using, and that's the unique way that we deliver value to our clients. So let me sum up what we just said in one big slide here, and that is that the right way to invest is to diversify by strategy. And with each one of the money managers we're going to choose, we're going to measure their consistency and measure their conviction and make sure that they're delivering the best opportunity to outperform against their peers in their strategy. What we want to avoid is expensive closet indexing. We don't want to do that. So that is how we manage money here at A&I Financial Services. Let me sum up what we just talked about from the very highest level, beginning actually with what Stacey said, and that is that the number one determinant of investor success is investor behavior. And the best way to plan for that is a real-life financial plan, one that helps you achieve the goals that are most important to you in alignment with your relationships and your values. From there, we're going to choose an asset allocation. And the most important asset allocation decision we can make is how much we have in equities, because using history as our guide, equities deliver the best return over time. And finally, the right way to invest in equities is to diversify by strategy. You know, when faced with a big, complicated set of decisions, we often come back to our core values, those principles that we started our presentation off with today. And none of us can say with absolute certainty what the future holds. So our answer to that is a healthy dose of humility. And diversification across strategies is humility in action. Hey, it's been a blessing to have this opportunity to talk with you. I sure hope that you look us up and talk to one of us even further. We could describe what this looks like in your portfolio. Until we meet again, create another beautiful day. Bye-bye.